now I'd like to introduce Brett Winton, our Director of Research. Brett Winton and I have worked together now for roughly 15 years. Brett was the lead analyst in our strategic change group at our former firm. And I selected him as Director of Research for a few reasons. First of all, I saw his talent. I had been working with him. But second, Brett is an MIT engineer by training, and that's a very good starting point for what we do. Brett also, when he got out of MIT, had aspirations to reform the educational system in California, and started on that quest and realized that perhaps he'd do better moving into business development at startup companies. So with those three experiences, I couldn't think of a better person to join me and focus exclusively on disruptive innovation and the opportunities that it will create and the exponential growth opportunities it will deliver over time. So Brett, take it away.
Thanks, Kathy. And hello, everyone. As Kathy said, I'm Director of Research at ARK Invest. So what does a Director of Research do? I keep the analysts focused on the time horizon that matters in innovation, which is over the medium and long term. And so our analysts focus at the technology level. We look for convergences. Ultimately, I help guide the cost decline and unit economics forecasts that form the body of our work to understand what the addressable markets in these technologies is going to look like in 5 and 10 years from now. And as Kathy said, within the equity space and particularly within the innovation space, the long term is the time horizon that matters. And as you'll see as you work through this big ideas deck, and as you hear some of the information we're sharing with you today, it really is a unique time in technological economic history. So I'm happy to share with you our Big Ideas 2022. We put a lot of time and work and effort into it, and the analysts have done tremendous work to dimension the opportunities that lie in front of us and the technological capabilities that they'll unveil. And I'll share that with you now. So one of the things that we've noticed in particular over the last 6 and 12 months is the degree to which the innovations we're focused on are converging. The way in which AI is feeding into genome sequencing and the insights you can get from that molecular information, the importance of blockchains in the consumer space is not something that anybody foresaw 24 months ago, and now almost every consumer-facing company has some kind of NFT strategy, some of which even make sense. And so kind of the convergence of technology is where a lot of exciting opportunities lie, both because there's likely to be more misunderstanding there, and you can get these compounding effects where you have an S-curve building on top of an S-curve, and the overall opportunity set for a set of businesses can amplify. I'm going to spend a brief moment going over disclosures. As Kathy said, there's lots of volatility involved in investing in innovation. People often mistake volatility for risk. I think volatility is better understood as uncertainty. The future, the set of possibilities that is out there for these innovation platforms and innovation companies has a wide error band around it, and that's why it's important to focus on a longer term point of view, so that you can get into that upper bound of the error band, or so you can get into an error band that's out far enough that economic value has been demonstrated. There's other risks that you can read about here. Ultimately, the way we think about it is that we're going to make some forward-looking statements, and we may be wrong about those forward-looking statements, and there's all kinds of known and unknown risks and uncertainties associated with those. So as Kathy said, there are 5 innovation platforms that we focus on: AI, energy storage or battery technology, blockchain, in particular public blockchains, robotics, and then DNA sequencing, or I think of it as gene read-write. And this is the composite forecast of the 14 technologies that we focus on and the aggregate market cap appreciation that we anticipate accruing across each of these 5 technologies. As you can see, the rate of growth is very high. Not only that, this suggests that the market capitalization attributable to innovation will exceed meaningfully the market capitalization attributed to other businesses over the next decade. There was an old saying in emerging markets investing where you could see that GDP was going to accrue to the emerging markets, so then you had to deploy assets, your own exposure to the emerging markets to take advantage of that GDP accrual. And we believe the same is true within innovation. If half of market cap is going to be attributed to innovation, then from a allocation perspective, you're better off being in front of that wave than waiting for it to occur. So AI, collectively, these five technology platforms we expect to accrue over $200 trillion in value over 10 years. In the underlying deck here, there's a lot of detail behind this, and I'll go through a little bit of detail on each platform to explain how we derive these values. Both in this forecast and in our underwriting of individual securities, in our 5-year price targeting, we're not assuming that investors are going to pay some kind of extra normal amount for the cash flow spilling off these platforms. Instead, you can roughly think about it as defining most of these technologies as being priced as generating a 5% cash flow yield in the out year. And so in some instances, this is implying an extreme multiple compression in the technologies, though given equity prices today, it's not as true in other instances. So this highlights the 14 underlying technologies that fit under these platforms. So purple is AI, and that comprises cloud computing, Internet of Things, mobile connected devices, and AI itself. Blue is the DNA sequencing space, the genome space, gene editing, gene sequencing, living therapies. Green is battery technology, including autonomous vehicles. Yellow is blockchain and digital wallets, and then red is the robotics space. And this is also a scoring of the convergence between these technologies that we've done, which illustrates both that each technology is discretely modelable, but there is also important dependencies between the technologies. One of the reasons to be optimistic about robotaxi and the economic value that robotaxis can deliver is because of the fundamental innovation happening in the AI and neural net space. Over the last 24 months, there have been massive breakthroughs in natural language processing, which is a tremendously open-ended problem. And so it's more likely, in our view, that then robotaxis will be solved given the fundamental capability of the neural nets that support the natural language processing space. And this is how kind of a visualization of how the asset value accrual will break down. Again, you can see that each of these technologies against which we have defined a cost decline curve and done unit economics cases for end buyers are experiencing steep cost declines. They also cut across sectors, which is an important characteristic, and we align our research by technology rather than by sector because it helps us to understand the total addressable markets better. And they're all also platforms of innovation on top of which other technologies can be built. So I'll spend a moment on each technology platform and then move us on to the rest of the show. Within the AI space, we expect that artificial intelligence and the associated technologies will yield more than $100 trillion in market capitalization by 2030. There's mobile connected devices here. That includes expectations for augmented reality headsets and the constellation of devices that you wear on your person. And the data feeding off those devices feeds into kind of the AI models that we believe are going to drive the future of software. Cloud computing is kind of the infrastructure as a service layer that gives us access to a supercomputer in our pockets from any connected device. And as a response to the demand for AI, we think there's going to be a meaningful increase in compute hardware spend to support it, exceeding $1 trillion. And then Internet of Things is fixed connected devices, so the smart speakers, the smart TVs, and you can think of this as the media retail space that lives inside your home that allows you to frictionlessly buy things through e-commerce platforms and frictionlessly access media and potentially public blockchain Web3 assets. And of course, AI itself, and this drives a lot of the value accrual expectations here. The value accrual is predicated on the fact that the advances in AI suggest that it's not going to be considered artificial intelligence, but instead augmented intelligence, where every knowledge worker will become more productive. Every software engineer will become more productive. And the productivity value that we anticipate spilling off AI will actually meaningfully exceed the revenue that AI software companies will capture. And yet still, we believe there's $14 trillion in AI software spend that will occur by 2030, leading to that $80+ trillion in enterprise value. Within the battery technology space, this is where we capture both energy storage opportunities as well as autonomous mobility. There's some nuance. Autonomous mobility and robotaxi in particular, we believe is going to be the most economically productivity generating innovation of all time. And the logic is relatively simple. We spend 700 to 800 billion hours driving a year as amateur drivers. And so if you can displace that at a discount to the economic value of it, people will happily pay to be driven around. And you end up with this economic value creation of the freed up time. And this is true of a lot of innovations where you take non-market activity. Here, when I drive around in my car, I'm not getting paid to do so, but I would happily pay another service, inexpensive service, to drive me around. And then I could spend that time, working, doing modeling, or binge watching Narcos on Netflix. And any of those activities manifest as economic value add, whereas previously those hours driven were not economically productive hours by GDP accounting. On the battery technology side, it's interesting. It seems as if the automotive space is being priced as if the pricing structure of selling cars will not transform, and as if every single competitor is going to trend towards Tesla-like margins on their ability to produce electric vehicles. We think that's probably misguided. It's hard to imagine autonomous mobility services coming into play without dramatically changing the unit cost of a vehicle and the form factors that will be sold into the market. And so tread carefully there. Within the robotic space, this includes 3D printing, where you can essentially manufacture any part on demand. You can de-risk supply chains. You can get complexity for free, and you can deliver better performance, particularly within aerospace on low volume units. It includes robotics, and we have a back-end weighted expectation for robotics value accrual. It's heavily contingent upon continued advances in neural nets, but just like we think that AI software can augment knowledge workers, we think robotics within the manufacturing space can become much more flexible and software defined. And that would meaningfully increase the productivity of the world of built things. And then reusable rockets. And with reusable rockets, you have crossing 2 orders of magnitude in cost declines of getting things up into orbit. It seems like the most meaningful opportunity here is in low Earth orbit satellite constellations delivering connectivity. But it's still in a very early stage as to what's going to be realized with that technology, including potentially hypersonic travel around the world and transformations in logistics on that basis. In the genomic space, there is amazing convergence between these technologies. The inexpensive gene editing that's been delivered by CRISPR technology yields insights and easy experimentation, which then makes the sequencing, generating the molecular information more valuable, which then allows us to discover kind of more diseases and disorders and the fundamental molecular basis of them, which enables us to develop and deliver living therapies into the body to cure them. And so this is the technology platform that's in its earliest stages, and it has perhaps the greatest potential for providing benefit to humanity as we are able to hopefully eliminate pernicious diseases and understand exactly what they are. And then finally, within the public blockchain space, and we're going to share a lot of information about blockchains in the next hour or so. We think that this should best be understood as three concurrent revolutions that have all been catalyzed by the introduction of Bitcoin into the world. There's a money revolution, which Bitcoin is positioned to win. There's a financial revolution, which comprises the DeFi space and everything that's happening with smart contracting within the financial ecosystem. And then there's the consumer internet revolution, which includes all of the experimentation going on with NFTs, and including people buying, digital JPEGs for hundreds of thousands of dollars. The other technology that we categorize here that's often overlooked is digital wallets. And here, so you can think of public blockchains as kind of tearing apart and remaking the back end of the financial ecosystem. How are assets custodied, kept track of, transferred? We believe that digital wallets are refiguring the front end of financial ecosystems. The two largest consumer-facing financial companies in the US, as we think about it, are not traditional banks, but Venmo and the Block's Cash App. And it's actually hard to imagine that 10 years from now, you will be going into bank branches to conduct financial transactions. We think that model doesn't make sense. Instead, it's likely that these front-end digital wallets that can cross-sell you into all kinds of financial services and have very low customer acquisition costs, and become increasingly important if you're in a multi-asset world where you're transferring in and out of cryptocurrencies, have almost $10 trillion in market capitalization globally that they'll occupy. So that's an overview of the technologies that we cover. The analysts have done incredible work modeling, dimensioning, running cost declines on these technologies, and one of the key characteristics that we believe differentiates us as a research team is that not only are the analysts focused at the technology level, but we also try to open source our research into the world that then also forces us to be very good at communicating to each other internally about our expectations, and so that the research team can build on each other's work. And in an era of convergence, in an era where kind of batteries and AI are both key inputs into enabling robotaxi, and both of those kind of expert areas need to reside in a company like Tesla. It's important that you have a batteries analyst that can build on top of the work of an AI analyst and vice versa. And as a team, I think that we are well positioned both to understand where technology is going and to appropriately model the S curves that can compound on top of S curves as a result of these convergences. So please enjoy the remaining presentations in Big Ideas, and please look through the deck, and I hope to see you on Twitter. Thanks.